Hi everyone, Jonathan and Eugene here from TBI. We recently received a couple of questions on what we view as the major factors driving the markets at the moment, and as such decided to put this short video together. So Eugene, what have you observed in the market in terms of the trends, and how is this playing out now at the moment?
Um, Jonathan, hi. Yes, I think what we need to do is stand back quickly and see what has evolved since the Great Recession. Over the past couple of years, monetary authorities have really struggled to get inflation up to a level that is healthy. But over the past couple of years, growth has been very good, especially in developed markets. And we are seeing good inflation coming through in the United States and Europe, and to some extent in other developed markets. But the same for emerging markets as well. So good inflation will prompt monetary authorities to start increasing interest rates. And I think that's the first factor, very important, that we're seeing interest rates rising, and that has caused some volatility in the market. The other factors, of course, the Trump trade wars, which is causing uncertainty and disruption in our markets, and it's driving these markets in a very volatile manner.
Oh, all right. So I mean, coupled with this rising inflation and rising interest rates, we're also seeing the central banks sort of slowing down or stopping their quantitative easing. So I mean, now you've got this combination of the rising interest rates, the QE, the Trump trade wars, and all of this seems to be playing out into like a lot of volatility in the emerging market currencies. I mean, is that the only thing driving that, or what else is at play here?
So interesting, what we have seen in the run-up to where we are now is that because of cheap money and extremely low interest rates, investors have engaged in what they call the carry trade. So they borrow dollars extremely cheap, sell the dollar, buy emerging market currencies like the rand or the lira, and with the proceeds they invest in the likes of bonds. So what will happen? Selling a lot of dollars made the dollar cheap. Buying a lot of emerging market currencies kept the emerging market currencies very strong and push yields down. The end effect is that the liquidity that was pumped into the US and is being pumped into Europe has been translated into free cash in emerging markets. So the cheap cash was used to invest, and that caused very, very good growth.
Okay. All right, thanks, Eugene. So now, with this more expensive funding, what does it actually mean for our equity markets? I mean, if you look at the likes of the JSE, it's been moving sideways for a number of years now. And with this more expensive funding, does this mean that we're going to see this sideways movement persist? Or could we actually see more volatility or even a correction in the markets?
In the developed world, especially in the United States, we've seen that the guys have started hiking interest rates. Interest rates are getting more expensive, so we are seeing an unwinding of this carry trade we just explained. We're seeing a stronger dollar, we're seeing weaker emerging market currencies and emerging market assets being sold off. Now that's been the case for the past 6 months, and especially in a country like China, we've seen the equity indices down like 20%. In the domestic space, our equities has basically done nothing for the past 3 years. So the more expensive cash will cause the consumer more money to, for instance, pay off his bond or borrow on his car, and it's going to cause consumer sentiment to dwindle, and eventually it will flow through to normal growth. So we expect developed market growth to taper down a little bit. It will flow through into emerging markets, and I expect developed equity markets to either correct or at least start moving sideways, and we are going to see volatility as markets and participants become more and more uncertain. And the same will evolve into the emerging market space.
Right. So if we're going to be seeing this new bout of volatility or some sideways movement in the markets, what is TVI's view around the global and local markets and the various asset classes?
So focusing on equities, we prefer developed market equities against emerging markets at this stage. We believe emerging markets is a higher beta play. In other words, it could be more volatile and more sensitive to economic growth. So we would rather invest in developed markets than emerging markets. However, if you compare equity markets to bonds, property and cash, we prefer to invest in cash or short duration bonds. In the United States, your 2-year bond is very close to where your 10-year bond is. And in the local environment in South Africa, we also see that the short-term interest rates up to 2 years is very attractive relative to what you're going to get on the 10-year bonds. So we prefer cash, short-term bonds, and I think the ideal investment vehicle here is tilt towards income funds.
And then what about the preference with regards to capital protection versus going straight into the vanilla equities?
That's a very good point. So if you look at equity markets and the potential risk that we believe will evolve over the next 3 to 5 years, one needs to invest in equity markets from a long-term perspective. But if there's a potential of substantial drawdowns, like we saw in the Great Recession, I would prefer a equity investment via a capital guaranteed or protected structure. In other words, you've got your capital protected for, say, a 5-year period, and you're not going to be exposed to this potential drawdown or volatility over that term. And then obviously these kind of structures give you some form of leverage on the upside, which is very attractive.
Great. Okay, perfect. Thanks, Eugene. So if any of our viewers would like a little bit more information, they're welcome to go onto the website and have a look at our latest newsletter, or alternatively follow the link below the website. Thank you.